Right, what's going on everyone? Want to do a new style of video today, much more informal, basically just running through my current style of trading, how I'm taking my setups, the mindset, execution, and process that goes into trading, trending conditions, and essentially how to scan and execute trades on altcoins in these markets. Okay, so let's kick things off with scanning. How are we scanning the watch lists at the moment? Essentially, my primary method of scanning is taking the 4-hour time frame and just flicking through, okay? Just flicking through the 4-hour time frame and basically either marking out absolute final highs or independent highs, okay? So you can see here we have two examples of independent highs. What independent highs mean is that we have highs that are relatively independent from other highs, okay? So I've taken this one because firstly, there is 17 days, or let's not even count the days, right? It's a noticeable visual gap from the previous left side price action over here. As well as that, the next high we could mark is up here, which is a fairly significant distance, okay? Just about acceptable, right? So if this high was instead here, or perhaps even lower, like so, then this high wouldn't be an independent high per se, okay? Reason being is because there is another local high within the vicinity, right? Even better if it was, say here, for instance. Essentially what you don't want to be doing is just marking highs which are within a cluster of other highs, okay? So the independent high, such as this high here, or this high here, this is just a random market that I landed on. So not, the paragon of examples, but yeah, just to give you a notion of what independent highs look like, this is kind of what I'm looking for and marking out on my 4-hour time frame, or the absolute high. Okay, so the absolute high, otherwise known as the final high, is the best point at which I can do business in these markets. Basically, it means the very last high within this cluster of price action. Okay, so you can see that it's very clearly these equal highs up here. It happens to be equal highs, doesn't have to be equal highs. And that's really mainly what I'm looking for and looking to mark out, okay? So I basically just scan through and I'll either mark out independent highs. Again, you can see some equal highs here. And I've got a few independent highs I could work with here, or the absolute high, right? And the reason I'm using the 4-hour time frame in particular is because my primary time frame is the hourly. And so what I like to do is scope up slightly. It could be to the 2-hour, it could be to the 4-hour, but whatever your primary time frame is, just jump up a bit, okay? Because essentially then what you can do is get a more holistic view of the market, a more bird's eye view, and you're really marking out the best points at which you can do business for swing failure traders like myself, sweep traders, stop hunts, whatever you want to call it. We really want to be marking out the creme de la creme of the levels we can work with, okay? And the best way to do that is to scope up slightly, jump up slightly in time frames. Otherwise, what you can do is you can just get sort of lost in the source, right? Get lost in the lower time frame source. You can start marking stuff like this as independent highs, where really if you jump up, you can see that there's nothing really particularly significant about this level. It's within a cluster of price action here, and it's not really the sort of level that we want to be working with in particular. So that covers how I'm scanning for my swing failure or sweep trades, well, also deviation trades as well. Essentially what I'm looking for price to do is, so we can mark out, we happen to have landed on AVAX, which is a great example. This was an independent high, not an absolute final high. Okay, so I was marking out levels during this period of price action. You can see that this is the final high up here. this was the independent high we were working with. Let's say we were within this period of price action here, and waiting for either the independent high to be taken out or the final high, which is far less likely, and of course price would have to move very aggressively for it to do so. But as I said, this is the best point at which I would like to do business, but I have to understand and be cognizant of the fact that most of the time price will not be that aggressive, the short squeezes will not be that powerful, and I will more often than not have to work with the independent highs as opposed to the absolute or final highs. So it's just a balancing act, never a black and white scenario in trading, which is what makes it particularly difficult and hard to master, is that it's very much context-based, very subjective, and never really black and white, usually a balancing act, right? So here what we're balancing is the value between stringency, right? So waiting for the very best setups, but then of course, taking opportunity cost into the equation as well. Okay, so we don't want to miss out on setups, but we also don't want to be, marking levels willy-nilly, getting lost in lower time frames, and working with levels that would present themselves more often, but would be crappy levels to work with, right? That being said, I do also scan my primary time frame, being the hourly time frame as well, and I'm not looking for key highs when I'm scanning. Essentially, all I'm looking for are intra supply zones. Okay, so if we were scanning this in a bull market, I'd still be scanning the hourly, looking for intra demand zones, right? And what do I mean by intra supply, intra demand? Essentially what I'm looking for is a period of consolidation within the impulse downwards. So if we scope down to the 30-minute here, we can see an example, not the best example. Again, this isn't a textbook zone or cluster of intra-supply. If you want to see what a textbook zone or cluster looks like, please check my video named Supply, Demand and Order Blocks within the Ultimate Trading course. But yeah, essentially what I'm looking for is, not on the 30-minute, but on the hourly and above, zones of intra-supply where again, price could revisit, potentially have some confluence like a divergence into, as price makes higher highs and the oscillators then make lower highs. But again, it's simply just a way of joining a moving trend. Okay, so the hourly for intra-supply and the 4-hour for key highs, either absolute highs or independent highs. So let's pop back to AVAX, because that was a nice example we can work with to really dive into the execution side of things. Okay, so we are on the 2-hour time frame at the moment, and yeah, as I said before, within this period of price action here, I had 2 highs marked out. Okay, so we have the independent high here, the first real independent high we can work with, and the absolute final high up here as well. So if we scope over to the 4-hour, just to sort of double check our logic, this looks good for an independent high, this looks good for the absolute high. The absolute high is of course much more objective. Independent does get more subjective, okay? So it does take some practice to sort of mark out these levels. Essentially what you need to do is just use it with relative reason, okay? So you can start saying things like, right, this is 11.2% from the next local high above. That I can work with. However, if it was more like 5% in this region here, then I wouldn't mark this out as an independent high. Perhaps I would use this high instead as the next logical local high above. In terms of left side price action is up here, and it looks to the eye to be independent. Okay, so it really is about eyeballing, essentially, using common sense and some rational logic when marking out the independent highs, which are slightly more subjective. So in this case, I did indeed have an alert set here. I'll just use this as an example where we can say this was the alert. And essentially what I'm looking for is price to come up, take out the level Do so ideally as fast as possible, with as much speed as possible. So ideally, right, I'm not saying this is what occurred, ideally we dip down and we take it out as fast as possible. Essentially what this does is it leaves an inefficiency in the way, and it also exhausts price, okay? So it means that when price does come up to this level, it's stretching, it's exhausted. Again, if you want to dive into this concept of exhaustion, please reference my video on speed, where I talk about price, running out of energy points and stuff like that. But essentially what you're looking for is, price to come up as fast as possible, run out of energy, leave an inefficiency in its wake, devoid of any demand, and then most importantly form a divergence in this area, which tells us that A, the buy side momentum is teetering off, B, we do have a setup that could be taken within this independent high and not at the absolute final high, and we can start looking at execution. Okay, so that's sort of textbook ideal what we're looking for, right? So we'll see what happened in a sort of more pragmatic sense. So price just keeps ranging for some time, comes up, and you can see that it does do so relatively fast. Okay, we do have a bit of speed here. Again, the more speed the better, of course. So ideally, if price was, acting from lower here, and we had an incredibly sharp impulse, right? So lots of speed, a larger percentage within a shorter period of time, then that would be more ideal, more optimum. But again, we're rarely going to get the 10 out of 10 optimum setup with every single box ticked, okay? So we have to take everything with a pinch of salt and understand that, essentially we're joining a strong moving trend to the downside. Do we have enough confluence to enter the position? In this case, we can see that what happened if we pull out the oscillators here, and scope down to the 2-hour time frame, which would have been the primary time frame for execution, that we do indeed have that divergence that we were looking for. Okay, and as I said, this is the most important thing. We have a strong divergence here on the 2-hour time frame. Price is making higher highs here, and the oscillators are making lower highs. Okay, so we're taking the bodies of price here. We can see that we have a high, we have a higher high, whereas on the oscillators we have the high and then it makes a lower high, right? So the oscillators are diverging against price. Again, I have a full video masterclass on divergences if you want to dive into this concept further. But we have a clean divergence on price. The RSI heavily overextended. Both peaks of the divergence very overextended up here. And price has taken out the independent high that we had of interest, okay? So essentially this was a divergence technically plus a deviation, okay? It's a deviation, not a swing, failure, or an SFP, or sweep, stop hunt, whatever you want to call it. It goes by many names, because if it had been a sweep, then essentially what would have happened is price would have simply taken out the level here, wicked above, right, as it has here, closed underneath, okay? So that's not what happened. Price danced around above the level a little bit, formed the clean divergence, then locked in the divergence. I'd use this candle here. This candle in here would be the real divergence confirmation, which is the first, well, it's meant to be the first red candle that forms after this ascent of green candles. But yeah, you can either take this one here or this one, which is slightly stronger, right? So it's just confirming that divergence a little bit more. And simply take your entry on the time frame at which the divergence is occurring. Okay, so let's say we took the strong, more confirmed divergence confirmation candle, and let's say we had our stop something like this, targeting the lows and working with a solid trade setup here. Okay, so this is a very realistic, responsible position that you could have taken. The reason I say that is because you have a good wide stopping distance to work with initially. Sometimes, not always, but sometimes with divergences, the positioning can be very awkward, can be very nasty, and oftentimes they can put in the final leg of the divergence, which can come as a surprise. And essentially what it looks like is something like this, where price essentially makes that last very powerful leg of the divergence before then closing and then diverging, then locking in the deviation that sends it much lower. Okay, so we always really want to have a wide stopping distance when working with trades like this. Okay, and most of you may be looking at this going, right, well, this was an awful play out. Okay, I could have just taken this divergence confirmation candle here. It was good enough to be a confirmation candle with some credence, and I'm just going to put my stop up here. And if you want to do this and take this approach, then by all means be my guest. I know through years of trading divergences, a lot of pain and experience with them, that this method of tight stops is very risky. I got burnt over the years multiple times trying to take this approach, maxing out my R. I basically turned a +3 R trade to an 8.45 here. My only advice, if you do want to go down this avenue, is that you should take a 2 or 3 stab approach to the trade, whereby if you do get that last leg, that last impulse of the divergence that takes you out of this tight stop trade, that you are willing to step back in, right? If you do get that last impulse and then another confirmation candle whilst the divergence is still valid. What I mean by that is that it is still technically diverging, right? So the RSI, the awesome oscillator, are still making that lower high structure. That second peak hasn't drifted up here. It can do slightly, right? Ever so slightly. But best practice if you're new to trading divergences is only take something that has equal highs at most, basically. But yeah, just a word that you should be taking second or third stabs, right? And therefore, taking these fine with higher R, but lower size, so you don't burn out your accounts. Okay, so manage your risk appropriately and responsibly. I've learned over the years that having a wide berth on the stops is optimal for me. Reason being is because the div can keep divving, and then I can build further into that position if in that eventuality, and it's a win-win for me, right? Because if it plays from here, right, I'm in for nice size, that's all good. Not the most I could be in as opposed to this setup here, but it's still decent size, it's still a win in my books, okay? But if it goes against me, I can build further into that divergence, and then, in that eventuality, I'm not caught off guard per se. I haven't been stopped out. I haven't lost the position. And essentially this method of responsible stop placement, responsible trading, isn't the sexiest, right? I'm not looking for those home runs. I'm not looking for those 20, 30 R trades. What I'm looking for is a high win rate on my account. And with a high win rate comes confidence in my statistics, which means that I can subsequently progressively size up into my trades as time periodically goes on. So again, just a word on stopping distance and why it's my preferred method of execution. It grows my account over time, slowly but surely. And anyone that knows about account growth knows that the value in compounding wins when taking risk on a percentage basis based on your account. So it's served me the best over the years. It's also a much less stressful method of trading. So yeah, all in all, my method, my go-to. But of course, feel free to experiment if you do want to go with tighter stops. Just cater for that second and third stab attempt. Okay. In terms of taking profits, I advise you guys to take partials along the way. but then also have it be a balancing act with letting the trade breathe, okay? So both letting the trade breathe and letting the trend do the work, okay? So once you're executed, once you're comfy in your position, the hard part's over, essentially. And you should let the trend and the strength of the trend carry your trade and do the legwork for you from then onwards. That being said, taking partials along the way at these sort of micro swing lows is also a very responsible way of trading. Like I said before, account growth comes from responsibility, discipline, stringency, etc., and all the things that aren't sexy to new traders. But essentially, that's how professionals operate. Okay, so taking partials at these micro swing lows, and it can be small partials, guys. Okay, so I'm always advocating, not thinking in black and whites, not thinking in extremes. I often speak about how traders are mavericks by nature. They are, black or white, all or nothing thinkers. But when it comes to trading, that's a huge demon of most traders, a massive kryptonite, and we should start thinking more in partial measures, right? And stuff like, for instance, here, yes, the first micro swing low, the first hitch, the first trouble area, whatever you want to call it, is very, very close to our entry. So here we could set, a 5 or 10% limit, okay? So it's not very much at all, but you're just chipping away those tiny bits on your position, locking in some gains along the way. And let's say at this point, we've taken 5 or 10% off the trade. Price comes down here. At that point, we tighten up the stop like so. Then we have a further 20% TP at this swing low here. So let's say it was 10% here, 20% here. We've taken 30% off by the time the trade comes down here. And then the majority at this swing low here. So 10, 20, 30, 70 here. And this sort of style of trading is both, harmonizes responsibility with maximum value, okay? Now, when taking the main chunk off the trade over here, there's 2 ways that you can do it, okay? Well, there's 3 ways actually. So let's run through the first 2 automated limit formats first. The first is obviously just having a single bid reduce only at this low here, okay? The second would be scaling a net of bids, right, in this sort of area here, like so. So scaling some bids in this area here. I use Silico Terminal to do this sort of business. I believe the function is now available on Bybit and some exchanges as well. But instead basically of having a single reduce only limit here, you have a net of about 30, 50, 100, whatever spacing you desire to take you out of the position, whereby if price does come down and wipes out all of these, then you've been taken out at an average in the middle around this sort of area here. The third method of exit is just simply setting a reverse alert, right? So instead of having the alert at the high here for our entry, we set the alert down here. And we can just monitor price and see if again we want to take a partial installment off the position, whether we want to at all or whether we want to let that position run even further, okay? So in this case, looking at price in real time here, we can see that we haven't had a sweep of the low per se, because we've had a close past the low, okay? So then the only outcome here is for a deviation of the lows to take place. Essentially what we're looking for is price to chop around, reclaim this level here, and then start moving upwards, okay? So on that reclaim, then we can start to look to close the position off. And yes, of course, that will mean probably closing in this sort of area here as price does reclaim this low. But what it also means is that, if price doesn't reclaim this low with confidence, we could run it even further down, okay? And treat this as a breakdown, a breakout, or a breakdown in this case. And we're squeezing even more value out of the position, of course, with much more associated risk on the trade. What I mean by associated risk is that we are essentially betting on the continuation of price past the absolute final low on the reverse side of things. So it's not something that I particularly advocate or am a proponent of for new traders. This is only for advanced traders who have been, on a very, very solid streak of wins, and then are into the territories of, really maximizing value on your positions as opposed to simply becoming profitable and getting some wins in. Now, another method of trading these markets is essentially continuation breakdown trades, right? So, as we've just spoken about, this could be a potential breakdown past this level here. But if we look at another market, for instance, AXL here, we have a good example of a breakdown. So, we can see it on the 4 hour for a bit more clarity. And essentially what we're looking to do is play these markets exactly the same as we would breakouts in bull markets, but to the reverse side. So we're looking for all the same hallmarks of a classic breakout trade, but simply applying them to the reverse side. What I mean by that is, for instance, consolidation prior to the breakdown, looking for resets prior to the breakdown. We want the RSI to have a good bit of steam, so you can see just before the breakdown took place, we have that patch of consolidation. We can see that the RSI has come up and reset to the 50 level or thereabouts, 45 to 55, and has built up a good bit of steam and momentum to then break down. Okay, so again, simply you're taking the breakdown candle. In this case, it would be this candle here. And then again, placing your stop, usually the other side of consolidation. We can give it a bit more room just to cater for some volatility in this area. But something like this would be a logical breakdown trade. Now, if you have an issue with taking these positions, which a lot of people do, it's probably because of your psychological disposition. And a quick trick that I recommend is just going to invert the scale here, invert the oscillators as well, and then essentially what you're looking at is dealing with a breakout trade. Okay, so you can even flip it to line chart, so you're not working with the colors of the candles, which are the only thing which indicate that this is a breakdown, not a breakout at the moment. Or you can just play around with your color settings of the candles. But for most, simply inverting is enough. And it's just a handy psychological trick that we can do within a couple of seconds that really sort of challenges our latent bias. What I mean by latent bias is that most traders, most participants of the crypto space are inherently bulls as opposed to bears, simply for the logic that they were born into bull markets. Myself, I came into the crypto space 2016, 2017, born into a raging bull market. Okay, so that first point of entry, that first introduction to the markets usually leaves its mark on us. And anyway, it's just a little hack, a little trick we can do to challenge ourselves when we are seeing these breakdowns. Anyway, I hope you enjoyed this different video format running through how I'm trading altcoins in these current market conditions. Again, it will be flipped to the reverse side if it was a bullish market, but simply how I'm trying to capitalize on the current volatility, align with the trend as much as possible, which is always a stance I want to take, and really squeeze as much value out of the markets as I physically can. So I've touched on a bunch of concepts in this video, from divergences to speed and the like. I think if you want to check out any of them, then please go to my trading course. It's dubbed the Ultimate Trading Course, and there's a host of videos there for you to tuck into on the technical side of things. What I'm going to do is just link an end video here on divergences, as that's probably the number one trigger on the execution side of things for myself personally. Anyway, again, I hope you garnered some value from this video. An insight into how I trade trending conditions, in particular this downtrend. Look forward to catching you all soon, and as always, happy trading.